Hey, this is Jeremy from Shine Insurance, and today we're going to dig into the 3 parts of your monthly mortgage payment. That's right, when you make your monthly mortgage payment, it is actually paying for 3 kind of different things with your mortgage company. And I'm going to dig into kind of what those 3 things are right now. So the first thing is what you would think that you're paying for, and that's called principal. The next thing is interest, and the hardest part to understand, and one of the more confusing parts of it, is the escrow account contribution. I'm going to shed light on all 3 of those things right now. So let's start with principal. Principal is the part of your monthly payment that goes towards paying down your debt. So you borrowed money from the bank, and of course you have to pay that money back. That makes total sense. And so each month, one part of what you're paying back to the bank is actually paying down the debt that you owe to them. So that makes sense, right? Let's dig into interest. Interest is the part of your monthly payment that goes towards paying the mortgage company for the privilege of borrowing their money. Now, we wouldn't expect a business to loan us a bunch of money, a lot of times hundreds of thousands of dollars, and not want something in return. And of course, they do want something in return. And interest is what they get in return. Extra money that you're paying on top of what you borrowed back to the people that you borrowed it from. Now, there are 2 different kinds of mortgages, 2 main different kinds of mortgages that you can purchase. And there's the fixed rate mortgage and there's adjustable rate mortgages. And the best mortgages are the fixed rate mortgage, which means the interest rate won't change over the course of the loan. So you know what you're getting. You know what it's going to be for the total course of the loan. If it's a 30-year loan and you have a 4% interest rate, then you know with a fixed rate that can't change. So that's the best kind of mortgage. The other kind, adjustable rate, unless you're a financial guru, really try to avoid these adjustable rate mortgages, and that's because they can change in ways that you just don't understand. And so 4 or 5 years down the road, you're paying a totally different monthly amount for your mortgage and actually paying a lot, maybe more interest to the mortgage company than you thought you would be, because it was adjustable. It could change. So if you're a financial guru and you look at a loan you want to get, it has an adjustable rate to it, and you really understand exactly how the whole thing is set up and it works for you, great. But for the rest of us, we want to stick with fixed rate mortgages because they're just easier to understand and they're more stable. All right, and then the third part is the escrow account contribution. And this is simply the part of your monthly payment that goes towards paying your property taxes and your homeowners insurance. So they're actually bills that are paid by your mortgage company out of an escrow account that you're contributing towards every month. So you're paying a little bit in each month, a little bit in each month, and then the bills for property taxes or the bills for homeowners insurance go to your mortgage company, and the mortgage company pays that. But of course, they're not going to pay it out of their own pocket. That wouldn't make sense. They're paying it out of your escrow account, a little tiny bank account that's connected with your mortgage. If you have a fixed rate mortgage, then insurance and taxes are really the only reasons that your monthly mortgage payment amount should ever change. Another really good reason to have a fixed rate mortgage is if something changes about your monthly payment. You get a bill in the mail from your mortgage company and it says, well, you were paying $900 last month. Now we need you to pay $1,000. You say, wait a minute, why? If you have a fixed rate, you know you can zoom right in on insurance or taxes to figure it out. Okay. Let's put this into a visual picture that we can follow through the rest of this video. So let's use the example of a $900 monthly payment. And in this example, we could say that principal, interest, and escrow are broken up into $300 a month for principal, $400 a month for interest, and $200 a month for escrow, and that would be perfectly reasonable. And we'll dig into why that would be here just in a second. But I want to zoom in first. I kind of want to push the escrow thing over to the side for a minute and just kind of put that on hold. Let's look at interest and principal. So let's look at what you're paying back, the money you borrowed and you're paying back, as well as the extra money you're paying to the mortgage company for the privilege of borrowing money from them. And at the very beginning, your monthly payment is going to have a lot of interest in it. And the principal might be a very small amount to start. So you're really not paying back a bunch of money that you borrowed. You're paying a ton of interest. And a lot of people say, oh, the mortgage company is setting me up or trying to make things harder for me. And, there's lots of different opinions on why it's set up. But let me just show you exactly what's happening here and why you're paying more interest than principal at the beginning of your loan. So let's use the example of a $150,000 loan, and you got a 4% fixed interest rate. So we're going to make all these numbers really, really kind of even. So I have it broken down here into year 1, year 10, year 20, year 30, what you owe at those given periods of times, and what 4% interest would be on that for a whole year. So let's just look at year 1. Year 1, we owe $150,000, of course, because we just borrowed that money. 4% of $150,000 is $6,000. And so over the course of this first year, you're going to need to pay back $6,000 in interest. And so what we do is we break down the monthly payment and we say, okay, the monthly payment is $900. And that's what's set at the beginning. Now I kind of want you again to push the escrow part out of this picture. I didn't want to remove it from the picture because it is the third part of your payment. But for right now, we're focusing on principal and interest. And as you can see, principal and interest will add up to $700 here. And all the way through my example, they're going to add up to $700. So in this first year, let me go back and remind us, we're paying $6,000 in interest. If we break that, divide it by 12, we know that we're going to be paying $500 a month. So we're paying $700 a month no matter what, every month for principal and interest through the course of the loan. If interest is going to cost us $500, then there's only $200 left to pay towards principal. So at the beginning of our loan, we have a lot of interest to pay because we still owe a lot of money. And so there's not a lot left for the principal to be paid if we're going to stick with that $700 for principal and interest. So $500 for interest leaves us $200 for principal. Now we jump to year 10 and we've paid down about $30,000. So what we owe in year 10 is $120,000. Now if we do some basic math here, $120,000, 4% of that is going to be $4,800. So on year 10, we're going to have to pay $4,800 in interest. If we divide that into 12 equal months, that $4,800, we're going to be paying $400 per month, right? So we have to pay $400 per month in interest. And we know that between interest and principal, we can only pay $700 because that's not going to change, never going to change from that $700 for principal and interest. So $300 is what we're paying for principal. Interest is figured first. Principal was what's left over between the two. So we had $400 in interest. Now we're paying $300 in principal. Okay. So year 20, you owe $80,000. And 4% of that is $3,200. So $80,000, $3,200. That means that for this given time, we are paying about $300. Now it's really going to be $3,600 that we're paying. So I'm off a little bit here on the number, but just to keep it even, let's stick with this idea that we're paying about $300 in interest. We know that the two broken up between principal and interest need to be $700. We're paying $300 in interest. That leaves $400 or about $400 for principal, and so that's what will be paid in principal. Notice now we're paying a lot more in principal. We've broken over that X, and now we're paying more in principal, less in interest, and so we're starting to pay down our loan more quickly, paying $700 a month for that interest in principal. And then finally, year 30, we've got $12,000 left. That means 4% of that is going to be $480. We break that by the month. That's just going to be $40 per month in interest. Obviously now the lion's share of that $700 is the principal, and now we're paying down the principal much faster, and that is because we're not paying as much interest. So over the course of a loan, we start with more interest because we owe more money. And we're not going to change the amount of money we're paying for our monthly payment. And so that doesn't leave very much space for paying principal. But as we move along in the loan, there's less and less interest that needs to be paid in that $700, which leaves more space for the principal. And therefore we start paying principal more, which means we start paying the loan off more quickly. So principal is the amount of money we're paying off that we borrowed. Interest is the amount of money that the bank is charging us. for the privilege of borrowing money from them, and those two things kind of cross over the course of the loan, paying more principal and less interest as we go. But there's a rookie mistake that we make, and lots of people make, and I made it on my first loan. I had no idea what my escrow account contribution was, and so a year or two into my loan, my monthly payment went way up, and I thought, the mortgage person had duped me, had set me up or something like that. And I was just wrong because I didn't understand my escrow account's impact on my monthly payments. So you're going to understand. In the next 2 minutes, you're going to understand exactly how your escrow account works. All right. So your escrow account, like we've said before, is for the sole purpose of accumulating money in a little tiny bank account that is going to pay for your property taxes and is going to pay for your homeowner's insurance. The reason the mortgage company wants control over this money is they want to know that it's being paid. If you don't pay your property taxes, the county can come in or the city can come in and put a lien on your house, all kinds of nasty stuff. If you don't pay your homeowner's insurance and your house burns down, then the mortgage company is left, you still owe a bunch of money and your insurance company can't pay to rebuild that house. And so there isn't any asset there for them to get that money back. And so they kind of want to know that those two things are being taken care of. And by including an escrow account in your mortgage loan, they know it's being taken care of because they're the ones making the payments. Okay, so how does an escrow account work? Well, let's just look at months. All right, month one. In this example, we're putting $200 into our escrow account, and so we've accumulated $200 in our escrow account. Month 2, we put 200 more, 400 altogether. Month 3, 200 in, 600 total. Month 4, we add another 200. Now we're all the way up to a big old $800. Month 5, 200 into 1,000. Month 6, 200 into 1,200, and then a homeowner's payment comes in, a bill for homeowner's insurance, and they want $1,000 for the homeowner's insurance. Now that bill, remember, doesn't go to you, it goes to your mortgage company, and your mortgage company is going to pay that out of what you've accumulated in your escrow account. And so your mortgage company is going to pay that $1,000. There it is right there, and that means that what's going to be left in your escrow account is $200. And so it just continues on like that. So month 7, you pay $200, and that accumulates to $400, and so on and so forth. You're paying a certain amount of money into your escrow account every month. That escrow account is accumulating, and then when a bill comes in, the escrow account is going to pay that bill, and it's going to be taken care of. Everything is honky-dory. Now, here's where you can get in trouble. What if your insurance becomes $1,700? So what if you get your mortgage company gets a $1,700 bill for insurance? Because insurance premiums can change. They certainly do change. And that insurance was, your mortgage company figured that it was going to be $1,000 for insurance, but then it became $1,700 the next year or something like that. What's going to happen to your escrow account? Well, that escrow account is going to get overdrawn because that $1,700 got paid out, and now you're at negative $500. And so look at what the mortgage company does in those cases. They say, oh, we're not collecting enough money. The bill was higher than what we thought it was going to be, so we're not collecting enough money. So what are they going to do? It maybe doesn't happen right the next month, but it can happen, at some point in the next 3 to 6 months. They're going to charge more money for your escrow portion of your mortgage payment. So here we got it up to $300, and now it starts to accumulate back up and help. So what does that do to your monthly payment? Now they've raised that to $300. Well, what's going to happen to your monthly mortgage payment there? Well, of course, the principal and the interest can't change, and so we see in this example we still have $700 that we're paying to principal and interest, so those aren't going to change at all. But the escrow now went up from $200 to $300, and so what's going to happen to your total monthly payment? Well, it's going to go up from $900 to $1,000. So your escrow contribution went up by $100, and therefore your total monthly payment went up by $100. They're related to each other, and that's where people get confused a lot. So that was it. Okay, let's review the 3 different parts of your monthly mortgage payment. We start with principal, and principal is the part of your monthly mortgage payment that you think you would be paying, which is going towards the debt that you borrowed, paying down the money you borrowed. You borrowed money, you're paying it back. Interest is the amount of money that we pay goes towards the mortgage company for the privilege of borrowing their money. They're not going to loan us money for free. Interest is how they make money off of loaning us money. And finally, your escrow account. This is the part of your monthly payment that goes towards paying your property taxes and homeowners insurance. Oops, jumped forward a little bit there. It can grow, and when the escrow portion goes up, that's going to cause your monthly payment to increase. All right, you got it? That was it. It's not so hard, right? 3 parts of your monthly mortgage payment. Now you know. So if you want to watch some other Shine videos, we got some great ones for you. Starting off with the new home buyer's guide. This really walks you through from beginning to end, from like it popping into your mind, hey, maybe I want to buy a house, you know, and all the way through to the very end. There's a little part of it that's very much about the same thing as this video here, what your monthly mortgage payment is, but it also talks about the escrow period, which is completely different than an escrow account, interestingly, and loans and all those kinds of things. So new home buyer's guide laid out really nicely for you, real simple. We've got 5 steps to a homeowner's claim. Something you should know whether you're involved in a claim or not. Like, I would definitely watch this video. It's only an 8-minute video or something like that. And so you just understand how homeowners insurance claims work. And then finally, if you just want to laugh, how not to light a bonfire. So it's part of our No Insurance for You series, and it's a video of someone making some pretty poor decisions that combine gasoline and a bonfire, and you can check that out over on our YouTube channel. Okay, what's next? As always, the last step in this video is really, really simple. If you haven't done so already, please head over to our channel and subscribe. You can click on this button right here, subscribe to our channel. We really create content that is intended to just help you understand the financial world. Sometimes it's about mortgages and buying houses. Sometimes it's about insurance. But we really want to make great videos for you. You can subscribe and then have those in your inbox as soon as we create them. And finally, of course, share this video in your social media world. If you got something from it, other people can do that too, because, you know, good information is only great if it's shared with others. So whatever your social media thing is that you do, just, you know, pop this video out there and share it with some other folks. Awesome. I hope you enjoyed this video. I know I enjoyed creating it for you, and I'm glad that you understand your mortgage payment in a way that you didn't before. So until the next time, have a wonderful day.